Altria Group ticker MO is currently trading at $45.85. Now in today's video I want to have a look at Altria and calculate its intrinsic value and figure out whether it is a good idea to buy the company at its current trading price. And to do this, we'll jump over to my fully automatic stock valuation spreadsheets, which I have created for me to simplify the evaluation of any company. Now the way these valuation spreadsheets work is that we will plug in the ticker symbol of the company we want to evaluate, MO in this case Altria, and all the metrics show up automatically. Everything is calculated automatically, the 9 pillars, the grams formula, the discounted cash flow model, multiples valuation model, etc. All the models we will use to calculate the intrinsic value of the company. And so if you find these valuation spreadsheets interesting, if you find them helpful and want to support me in my work, you can access them at my Patreon, which I have linked in the link in the description. Now getting straight to the valuation, the first thing we can see, the first thing that really interests us is the dividend yield of the company, which is sitting at 8.55%, a very high dividend yield for basically any company. Now a good rule of thumb is that when a company has a dividend yield of higher than 5 to 6%, it generally means that the company is a non-growth dividend company. These companies have a high dividend yield to attract investors, but don't really grow their investments via the shares they invest into. That means that the company doesn't really grow much in value, it rather pays out a very juicy dividend. Now the dividend payout of Altria is sitting at $3.92, and the trailing free cash flow payout ratio is sitting at 78%. Now we can also see that the beta of the company is sitting at 0.66, which means that the company is quite more volatile than the general company, which would be, for example, in the S&P 500. Now we can jump to 9-pillar analysis, and here we really look into the history of MO and figure out whether the company is doing good or whether it's doing not so good. So first we can see the 5-year PE ratio and the price to free cash flow, which we generally want to be sitting below 22.5 and below 20. Now that the 5-year PE ratio is sitting at 17, about 17, it means that you would be paying quite a fair price for the earnings of the company compared to other companies which you can buy, compared to other companies which are in the S&P 500, for example. The same with the price to free cash flow, except here we take the free cash flow instead of the earnings of the company. Now another good thing about MO is that they have decreasing shares outstanding over the past 5 years, which essentially means that in the long term you will own a bigger percentage of the company as long as they keep buying back shares from other investors. Now the company also has increasing free cash flow over the past 5 years, slightly decreasing revenue, and a high decrease in net income. But if we actually scroll down to the financials, we can see that the net income has only decreased a lot from 2016 to 2019. And since then it has been increasing again from about $2 billion, and it's currently sitting at about $8 billion per year. Now another two important metrics we want to look at is the long-term liabilities over the 5-year free cash flow negative dividends, which I generally like to be sitting below 3. Now if it's sitting below 3, it means that the company can pay off all their long-term liabilities while paying out their current dividend within 15 years. Now that this is sitting at 3.44, it means that the company, that MO, would take about 18 years to pay off all their long-term liabilities while paying out their current dividend, and that is if they wouldn't increase their dividend by a single bit, by a single point of a percent. So this is slightly concerning. Now another metrics we want to look at is the consecutive dividend growth, which is sitting at 7.35% per year. And again, if we actually have a look at this, it gives us an idea that the dividend might not be as secure as we might think. Now moving to the first valuation model, the grams formula, here we take the trailing earnings per share of the company, the base PE, 5-year growth estimate, growth rate multiplier sitting at 1.5, and the average yield on AA corporation bonds and the current yield on AA corporation bonds. Now the current yield on AA corporation bonds is sitting at about 5.2, but as we take the trailing earnings per share, which is for the past 5 years, we take the short-term average yield on a corporation bonds, which would be sitting at about 3.6. And this gives us an intrinsic value of $36.14, which is 27% lower than the current trading price, which gives us an idea that the earnings per share of MO, that the average earnings per share of MO over the past 5 years aren't actually that strong compared to its volume. Now moving to the next valuation model, which is the discounted cash flow model. Here we take the free cash flow of the company over the past 10 years and calculate its average growth rate to be sitting at 11.6%. Now taking this and the analyst growth rate projections over the next 5 years into account, I calculate a conservative growth rate of the free cash flow to be sitting at about 3.5%. Now if we plug this in, we get the future free cash flow of the company up till the year 2032, also calculating the terminal value. Now we also want to calculate the present value of that future free cash flow, accounting for inflation. And to do this, we will plug in the discount rate. Now to figure out the discount rate, we have to take into account the WACC of the company and the overall health of the company to evaluate what return we want from the company. So therefore, if a company isn't doing that well, I would plug in a higher discount rate, as I would expect a higher return from that company, looking at the risk to return ratio. For MO, I will plug in a discount rate of 10%, and using this, I calculate the present value of that future free cash flow, and then using all of this, I get the intrinsic value sitting at $64.95, quite higher than the current trading price of the company. Moving to the next valuation model, which is the multiples valuation model, we take companies that are in the same sector as Altria and we take their current stock price and divide by their earnings per share to get their PE ratios. We average out these PE ratios and compare it to the PE ratio and earnings per share of MO. So we basically multiply the average PE with the earnings per share of MO and take into account these are the current earnings per share. That is why in the grams formula we have 2.16, that is over the past 5 years, and in the multiples valuation we have 4.78, which is the current earnings per share of MO. So we take this and we multiply it with the PE, with the average PE of these 4 companies which are in the same sector, and get an intrinsic value of $64.05, again slightly higher than the current trading price of the company and quite similar to the intrinsic value we got in the discounted cash flow analysis. Now moving to the final valuation model, which is the dividend discount model. We take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at about 4%. I will project a growth rate of only 1% into the next years, and using this projected growth rate I'll calculate the next year's dividend, and using the WACC and the next year's dividend I'll calculate the intrinsic value of the company sitting at $68.75. Again, quite similar to the 2 previous valuations we've done before. And now moving to the ultimate valuation, we take the 4 valuations we did prior and get an ultimate intrinsic value of $58.47, which is about 28% higher than the current trading price. And plugging in a margin of safety of 20%, we get an acceptable buy price at $46.78, about $1 higher than the current trading price of the company. Now you certainly shouldn't go out and buy Altria just based off of this valuation. To be completely transparent, I do own Altria myself, but I will be selling out soon and reinvesting that cash into a different dividend growth company. Now I hope you enjoyed this video and let me know down in the comments which company you would like me to evaluate next.